Our featured guest is a veteran portfolio manager. He's got lots to say about this small elite group of stocks. He's Barry Schwartz, Chief Investment Officer at Baskin Wealth Management.
Veteran, young portfolio manager.
You're a veteran. You've been around for a while. Okay, there is a lot of investor angst about this. They're worried about these stocks losing their growth trajectory. Yeah. The S&P 500, if that were the case, would not look nearly as good as it does now. You don't share those worries. Well,
I always wake up worried, but hopefully long-term excited. Canadians know far too well what happens when a stock or a portion gets too big of an index, right? We all have the scars of Nortel, which was 35% of the index in 2000.
That's exactly what long-time investors old enough to worry about that are worried about.
That's right. We have to remember, though, Nortel never made a profit and turned out to have faced many lawsuits and then to go bankrupt. That being said, the Magnificent Seven, Paul, Berkshire Hathaway and Eli Lilly are now gigantic companies as well. I mean, there's just the bottom line is these companies are growing so quickly. The profits are so strong. The cash flows, the free cash flows, some of them are just getting started. Many expect NVIDIA and Amazon to start gushing free cash flow. So these companies are playing in gigantic markets. The world has never seen companies like this with the types of profit margins before. Companies that used to dominate the S&P 500 were names like ExxonMobil, which was a very cyclical business, or IBM, which was just one leader where there wasn't as many great companies. So I'm not so concerned. I don't think anybody should expect you're going to get the type of results you saw last year or the last 5 years or even the last 10 years. For example, Microsoft and Apple have compounded by close to 30% a year over the last 10 years. Part of that has come from profit growth. Part of that has come from multiple expansion.
Right.
I don't think you're going to get the profit growth or the multiple expansion from here, but that doesn't mean you're not going to make money. And that doesn't mean these companies can't surprise you. They have amazing balance sheets. And the potential for AI as well as cloud and other technology innovations are still dramatic.
Viewers who are familiar with you will know that cash flow is your big thing. You love companies that generate lots of free cash flow. What do we see when we look at the S&P 500 free cash flow generation from these seven versus the other 493?
If you look over the long term, companies that generate higher earnings and higher free cash flow tend to have share prices that correlate and go much higher. If you look at what the Magnificent Seven is doing, the free cash flows, the profit margins are way above the average S&P 500, not even close. And so you get kind of what you pay for. I remember, Paul, when I was a young kid and my parents didn't have the money to buy me a Nintendo, they bought me a fake Nintendo. And it only worked for about a half an hour and then overheated. We got what we paid for. They should have put up an extra bucks to buy me the real Nintendo. You have to think the same way when you're owning companies. If you're a value investor, expect to get a value company. But if you're looking for growth, if you're looking for the best in breed companies, you have to pay up for these companies. And if the metrics fall in line, like higher free cash flow and potential for tremendous growth, then you get what you pay for.
Microsoft now trading at a multiple of expected earnings per share, a PE multiple of 35 times. You think investors should not be wary of a 35-time PE?
I would say it's in the zone of kind of reasonableness. I would say that, remember that nifty 50 era that a lot of people talk about? That's when the biggest well-known companies traded at 50, 60, 70, 80 times earnings. Maybe we're there with the Tesla, although you see Tesla stock has been disappointing for the last couple of years.
It's the outlier, isn't it? It's becoming the Magnificent Six, in effect, isn't it?
Exactly, or the Superb Six. Yeah, so 35 times earnings for a company that has gigantic tailwinds. Microsoft is playing in all the right areas. AI, cloud computing, technology innovation, gaming, and producing so much free cash flow, and clearly the only of the big tech companies that's allowed to make acquisitions. No one else is allowed to make acquisitions. Meanwhile, Microsoft has, closed that big deal with Activision. So it's not super cheap. Obviously, I'd love to buy it at a pullback. So would the rest of the world. But if you believe, like we do, that it can still compound earnings and free cash flow by double digits a year, I still think you're going to make pretty good returns.
Which of these 6 or 7 do you like the best?
Well, I like Amazon the best right now because I just feel that Andy Jassy, the new CEO of Amazon, is working very hard to right the ship, keep costs under control, and I'm hopeful this year we're going to see a gigantic leap in free cash flow per share. The knock on Amazon, Paul, over the last few years is it's never can seem to produce that free cash flow, and investors have gotten fed up. But the last few quarters, free cash flow is finally there. They've cut costs dramatically, lots of layoffs, unfortunately, slowing down the growth, and the revenues, the earnings have caught up. And so Amazon, although it looks expensive on a current PE basis, we think the cash flow is just going to gush and the multiple is going to come down dramatically.